This one mistake is super common for Canadians when they're using their TFSA or tax-free savings account. The tax-free savings account is no doubt a very useful tool when it comes to investing and growing our money tax-free. But because of all the rules that come along with it, many people aren't really using it to its fullest potential and missing out on a lot of money at the end. So in this video, we'll be counting down the top 6 mistakes Canadians make with their TFSA. Starting with number 6 is trading too frequently. This mistake isn't that common, but I do want to start with this because there was an interesting court case in 2023 where someone was using their TFSA account for day trading and they made tons of money in a very short period of time. So at the end, the CRA ended up disallowing the gains to be tax-free and instead taxed him as if it was business income. This ended up costing him a couple $100,000 in taxes. So while it is uncommon, you should be aware of this because the consequences can be huge. Now, what exactly happened? Well, long story short, the person was a Vancouver-based investment advisor and he invested $15,000 over the course of 3 years inside his TFSA. And what he was doing inside the account was he was actively trading penny stocks. And by the end of the 3rd year, the value of the account was over $600,000. So it went from $15K to $600,000 in just 3 years. Then CRA comes in and says that since he was actively trading inside a TFSA, it should be considered as business income and be taxed instead of being tax-free. So when they're determining whether or not he was day trading, the CRA uses this list of criteria. So I'm not going to go through the entire list one by one because I don't want this video to be too long. But a couple of things to point out is they actually look at the frequency of transactions. Now, they never actually provide an exact number of transactions that's considered too much or too frequent. So it's really based on the context and the other factors considered on this list. For example, they also look at the amount of investment knowledge the person has and how much time they spend on actively trading. So in this court case example, being an investment advisor obviously did not help in his favor. Also, the last factor on the list was whether or not the investment was speculative in nature. So penny stocks or even meme stocks like GameStop or AMC back in 2021 would be considered speculative. And of course, crypto and NFT would be as well. So at the end, the court concluded that he was in fact day trading as an active business inside his TFSA. And so his gains would all be considered as business income rather than being tax-free. Mistake number 5 is having too many TFSA accounts. You can have as many TFSA accounts as you want. The only limit is how much you've contributed across all the TFSA accounts. But when you have multiple accounts, then it becomes more difficult to track your total contributions as well as managing your investments. And because of this, we usually don't advise clients to have too many accounts, unless there's a good reason to. For example, if it allows you to have better diversification for your investments, because maybe one place has access to a specific fund or investment that the other place doesn't have. Or maybe you're just trying to compare which platform to use based on its performance or how convenient it is, because it's a good idea to compare which platforms or institutions is the most suitable for yourself. Because a lot of people think they can only open TFSA accounts with banks like RBC, TD, or BMO. But in fact, if you just explore a little bit, then you realize that there's actually a lot of different institutions and platforms out there that could provide you with a better selection of investment choices, which means more gains and money in your pocket at the end. So once you've found 1 or 2 platforms that you like, do yourself a favor and keep things simple by consolidating everything into as few accounts as possible, while still keeping your diversification goals. Because if you have 3 different TFSA accounts in 3 different banks, and all of them are holding a balanced fund or portfolio, then in a diversification perspective, all 3 accounts are really just doing the same thing. Because an RBC balanced funds is basically the same thing as a TD balanced fund with only minor differences. And so there's really no reason for you to hold the same type of investment across 3 different platforms. And when you're considering consolidating your investment into one TFSA account, make sure you do a TFSA transfer instead of making a withdrawal and reinvesting it. Because a TFSA transfer will not affect your contribution room, but if you withdraw an amount and reinvest it within the same year, then you might actually run into over-contribution issues. And that leads us to mistake number 4, which is not understanding how contribution room works. So for TFSA, the contribution room starts accumulating at age 18. But for some provinces like BC, the legal age to enter into a contract is 19. So this means that if you're in BC, then you do need to wait until you reach 19 before you can open a TFSA account. But the thing to note here is that unused contribution rooms are carried forward for future use, no matter if you own a TFSA account or not. And there's also no expiry to when you need to use up that room. So when you open a TFSA account when you're 19, the contribution room when you're 18 is actually saved up for you. So you actually already have 2 years worth of contribution room when you first open your account. So if you're 18 or older in 2009, which is the year that the TFSA was first introduced, and you've never opened a TFSA account before, then when you open a brand new TFSA account today, you'll still be able to use the maximum contribution room of $95,000 because all the unused room in the past 15 years are automatically saved up for you. And if you're a new immigrant who's over 18 years old, then you start accumulating the TFSA contribution room the year you become a resident of Canada. So basically the year you arrive here. And when you invest inside your TFSA, any gains on your investment will not reduce your contribution room. Also, circling back to our previous point where we talked about withdrawing from your TFSA and reinvesting it, you don't actually gain back the contribution room until January 1st of next year. So for example, if you withdrew $10,000 from your TFSA, let's say in June, then you might expect that, hey, once I withdraw 10,000, then I should be able to reinvest the same 10,000 in July. Well, that's actually not how it works. You do get back the $10,000 in contribution, but the contribution room doesn't get added back until January 1st of next year. So what that means is between the period of when you withdraw and the January 1st of next year, you actually cannot reuse that amount of contribution room. You should also track your contributions within a year because even though the CRA account does tell us the TFSA contribution room that you have, it only updated on January 1st. So if you try to take a look at it in June, then it might actually not take into account any contributions you've made between January and June. And if you end up over contributing, then it actually results in a hefty 1% per month on the bounce over the contribution limit. So that's 12% a year in terms of penalties, which is probably more than the investment gains that you could have gotten. Mistake number 3 is naming your spouse as a beneficiary instead of a successor holder. When you open a TFSA account, you'll be asked who you want to name as a beneficiary or a successor holder. Now, you can name anybody as your beneficiary, but for successor holder, you can only name your spouse. And there's actually a huge advantage of doing so. The biggest difference is that when you name your spouse as a successor holder, when you pass away, the TFSA account goes directly under your spouse's control instead of being sold and closed down. So this means that they would have their own TFSA account, but they can also keep your TFSA account open and continue taking advantage of the contribution room. So this means that you would have double the amount of room for tax-free growth. Mistake number 2 is being overly aggressive with your TFSAs. Now there's lots of investments that are allowed inside the TFSA. So for example, funds, stocks, ETFs or GICs, and even high interest savings account, they can all be inside your TFSA. However, crypto, NFT, or collectibles or land are not qualified investments under the TFSA. Because the investment growth inside the TFSA is tax-free, a lot of people want to go as aggressive with it as possible. But you might want to think twice before doing that. Because when you withdraw money from the TFSA at a loss, you actually lose the same amount of contribution room permanently as well. So for example, if you invest $10,000 in one stock and you sell and withdraw it when it dropped 50%, then you would receive $5,000 on hand, and the contribution room that you gain back is also going to be just $5,000. So instead of the original $10,000 that you contributed, you now have lost $5,000 of contribution room permanently. This is usually why we advise clients to take the steady growth approach when it comes to investing, especially with their TFSAs. And if they really want to invest more aggressively, then the RSP or the non-registered account might be a better place to do it. And as the famous Warren Buffett would say, never risk permanent loss of capital. Because as long as you make a couple of good decisions during your lifetime and avoid making serious mistakes, then your future is going to be very rewarding. So before you decide what to invest in, talk with your financial planner or at least do your own research to see what's most suitable for you and in line with your goals. Finally, the number 1 TFSA mistake Canadians make is saving in your TFSA instead of investing. A lot of people like to use their TFSA as a savings account. And this is a wrong way to use the TFSA. It's definitely not their fault though, because the government falsely advertised it as the tax-free savings account, when it should really be called the tax-free investing account, because all the growth inside is going to be tax-free. So you should really be taking advantage of this by investing the money. And to show you the difference between saving versus investing over the long term, let's take a look at a simple chart that we've created. So assuming we maximize our TFSA and we'll continue to maximize it every single year, we can see that in year one we would have $95,000 inside the account because that's the current maximum contribution rule. Then next year it will be $7,000, and for future years it will gradually increase based on the rate of inflation. Now let's compare if we were to save into something that gives us 2% per year return, whether it's a high interest savings account or a GIC. So we can see that as it grows 2% a year, in 30 years it'll become $599,000. But if we were to look at the final column, which is when we invest the same amount but earning 6% return per year, then in 30 years it'll become $1.3 million. That's a difference of $726,000, or 2.2 times more than if you had just left it in savings. Of course, our illustration here is oversimplified because investments have up and down years instead of having a steady growth every year. And you might say the GIC rate right now is actually 5% instead of 2% that we're showing here. But as inflation starts to cool down, the interest rate will start to come back down over the next couple of years. And the interest rate will likely be closer to 2% per year over the long term. The point of this is to show you the huge difference it makes over time, even when the investment return is only a couple percentage point different, especially inside the TFSA account where the growth is tax-free. Because a lot of people think that a small percentage doesn't really matter. And that might be true if we're only talking about 1 or 2 years. But if we stretch it out over a longer period of time, then we can see that the compounding plus time will have a huge effect on how much money you have at the end. Similar to when you fly on an airplane, if the direction is even 1 degree different at the beginning, you'd end up in a completely different destination. And that is why our clients work with us, because most people are not looking for a 100-degree change, but rather they want us to help them optimize their financial plan to make these small degree adjustments.